Open a ZERODHA account. Chapter 4. Taxation for Investors. 4.1 Quick Recap. In continuation of previous chapter. Classifying your market activity. You can consider yourself an investor when buying and selling stocks after taking delivery to your demat account. If the frequency of transactions, buy, sells, is high, it is best to consider them as trades and not investments. If considered as trades, any income is non-speculative business income. Whereas if these are investments, then it falls under capital gains. Keeping this in perspective, you may have few questions. What is long-term? What is considered high frequency of transactions, buy, sells? We discussed this in the previous chapter. But just to refresh your memory, there is no set rule from the IT department to quantify frequency or determine long-term. As long as your intent is right, and you are consistent across financial years in the way you identify long-term or high frequency, there is nothing to worry. Denote: if you are indulging in equity delivery-based trades as frequent as a few times every week, it would be best to consider all of them as trades and classifying income from them as business income instead of capital gains. Reiterating again that if investing, trading on the markets is the only source of income, and even if you are trading with moderate frequency, it is best to classify income from all your equity trades as a business income instead of capital gains. On the other hand, if you are salaried or have some other business as your primary source of business, it becomes easier to show your equity trades as capital gains even if the frequency of trades is slightly higher. Updated the 2nd of March 2016. Finally, the Income Tax Department has brought in clarity by allowing an individual to decide on his own to either show his stock investments as capital gains or as a business income trading, irrespective of the period of holding the listed shares and securities. Whatever is the stance once taken, the taxpayer will have to continue with the same in the subsequent years. Check this circular. So essentially, stocks that you hold for more than 1 year can be considered as investments, as you would have most likely received some dividends and also held for longish time. Shorter-term equity delivery buy-sells can be considered as investments as long as frequency of such buy-sells is low. If you wish, you can also show your equity delivery trades as a business income. But whatever stance you take, you should continue with it in the future years as well. The focus of this chapter is on investing. Hence, we will keep the discussion limited to just points 1 and 2. We will talk about taxation when trading business income in the next chapter. 4.2 Long-Term Capital Gain LTCG. Firstly, you need to know that when you buy and sell long trades or sell and buy short trades, stocks within a single trading day, then such transactions are called intraday equity stock trades. Alternatively, if you are buying stocks, equity, and wait till it gets delivered to your demat account before selling it, then it is called equity delivery-based transactions. Any gain or profit earned through equity delivery-based trades or mutual funds can be categorized under capital gains, which can be subdivided into long-term capital gain LTCG, equity delivery-based investments where the holding period is more than 1 year, short-term capital gain STCG, equity delivery-based investments where the holding period is lesser than 1 year. Taxes on long-term capital gains for equity and mutual funds are discussed below. For stocks, equity 0% or nil tax. It is nil only if the transactions, buy-sells, are executed on recognized stock exchanges where STT, security transaction tax, is paid. As discussed above, LTCG is for holding period more than 1 year. If the transactions, buy-sells, are executed through off-market transfer where shares are transferred from one person to another via delivery instruction booklet and not via a recognized exchange, then LTCG is 20% in case of non-listed stocks, and 10% on listed stocks. Listed are those which trade on recognized exchanges. Do note that when you carry an off-market transaction, security transaction tax (STT) is not paid, but you end up paying higher capital gains tax. Note that a gift from a relative through DIS slip is not considered as a transaction and hence not capital gain. It is important that gift not be treated as transfer. And relative could be I, spouse of the individual, E, brother or sister of the individual, E, brother or sister of the spouse of the individual, IV, brother or sister of either of the parents of the individual, V, any lineal ascendant or descendant of the individual, V, any lineal ascendant or descendant of the spouse of the individual, V, spouse of the person referred to in clauses E. 2, V. For equity mutual funds, MF 0% or nil tax. Similar to equity delivery-based trades. Any gain in investment in equity-oriented mutual funds for more than 1 year is considered as LTCG and exempt from taxes. A mutual fund is considered as equity-oriented if at least 65% of the investable funds are deployed into equity or shares of domestic companies. For non-equity-oriented, debt MF, flat 20% on the gain with indexation benefit. Union Budget 2014 brought in a major change to non-equity mutual funds. As opposed to 1 year in equity-based funds, you have to stay invested for 3 years in non-equity debt funds for the investment to be considered as long-term capital gain. If you sell the funds within 3 years to realize a gain, then that gain is considered as STCG. 4.3 Indexation. When calculating capital gains in case of non-equity-oriented mutual funds, property, gold, and others where you are taxed on LTCG, you get the indexation benefit to determine your net capital gain. I guess we would all agree that inflation eats into most of what is earned as profits by investing into capital assets such as the ones mentioned above. For someone wondering what that inflation is, here is a simple example to help you understand the same. All else equal. If a box of sweets priced at 100 rupees last year, chances are the same could cost 110 rupees this year. The price differential is attributable to inflation, which in this example is 10%. Inflation is the percent by which purchasing value of your money diminishes. Assuming the average inflation rate in India of around 6.5%, if you had invested into a debt fund, wouldn't a big portion of your long-term capital gain at the end of 3 years get eaten away by inflation? For example, assume you had invested 100 rupees into a debt fund, and you got back 130,000 rupees per at the end of 3 years. You have a long-term capital gain of 30,000 rupees per. But in the same period, assume purchasing value of money is dropped by 18k because of inflation. Should you still pay long-term capital gain on the entire 30k? Clearly this does not make sense, right? Indexation is a simple method to determine the true value from sale of an asset after considering the effect of inflation. This can be done with help of Cost Inflation Index, CII, which can be found on the income tax website. Let me explain this with an example of a purchase/sale of a debt mutual fund. Purchase value, 100,000 rupees per. Year of purchase, 2005. Sale value, 300,000 rupees. Year of sale, 2015. Long-term capital gain, 200,000 rupees per. Without indexation, I would have to pay tax of 20% on the capital gains of 200,000 rupees per, which works out to 40,000 rupees per. But we can reduce the LTCG by considering indexation. To calculate indexed purchase value, we need to use the Cost Inflation Index, CII. Find below the Cost Inflation Index from the income tax website until 2014-15. Financial year CII. Before the 4th of January 1981 100. 1981 to 82,100. 1982 to 83,109. 1983 to 84,116. 1984 to 85,125. 1985 to 86,133. 1986 to 87,140. 1987 to 88,150. 1988 to 89,161. 1989 to 90,172. 1990 to 91,182. 1991 to 92,199. 1992 to 93,223. 1993 to 94,244. 1994 to 95,259. 1995 to 96,281. 1996 to 97,305. 1997 to 98,331. 1998 to 99,351. 199900389. 2000-01-406. 2001-02-426. 2002-03-447. 2003-04-463. 2004-05-480. 2005-06-497. 2006-07-519. 2007-08-551. 2008-09-582. 2009 to 10,632. 2010 to 11,711. 2011 to 12,785. 2012 to 13,852. 2013 to 14,939. 2014-15-1024. Going back to the above example. CII in the year of purchase 2005. 497. CII in the year of sale 2015. 1024. Indexed purchase value equals purchase value asterisk CII for year of sale, CII for year of purchase. So, indexed purchase value equals 100,000 rupees asterisk 1,024 497 equals 206,036 rupees. Long-term capital gain equals sale value indexed purchase value. Therefore, in our example, LTCG equals 300,000 rupees 206,036 rupees equals 93,964 rupees per. So the tax now would be 20% of 93,964 rupees equals 18,792 rupees. Much lesser than 40,000 rupees per you would have had to pay without the indexation benefit. Like I had said earlier, the indexed purchase value can be calculated using the above method for all long-term capital gains, which are taxable like debt funds, real estate, gold, among others. You could use the IT department's cost inflation index utility to check on indexed purchase value of your capital assets instead of having to calculate manually. Interesting thing to note in regards to 20% after indexation for non-equity oriented or debt funds. Most of these funds return between 8 to 10% and typically inflation in India has been around that for the last many years. So with the indexation benefit, you typically won't have to pay any tax on LTCG of non-equity oriented funds. 4.4 Short-Term Capital Gain STCG. Tax on short-term capital gains for equity and mutual funds are discussed below. For stocks, equity, 15% of the gain. It is 15% of the gain if the transactions, buy, sells, are executed on recognized stock exchanges, where STT, security transaction tax, is paid. STCG is applicable for holding period over 1 day and not more than 12 months. If the transactions, buy, sells, are executed via off-market transfer, where shares are transferred from one person to another via delivery instruction booklet and not on the exchange, where STT is not paid, STCG will be taxable as per your applicable tax slab rate. For example, if you are earning over 10 rupees per year in salary, you will fall in the 30% slab, and hence STCG will also be taxed at 30%. Also, STCG is applicable only when the income exceeds the minimum tax slab of 2 rupees and 50 paise LKS per year. So if there is no other income for the year and assuming there was 1 rupee LKS TCG, it would not entail the flat 15% tax. For equity mutual funds, MF, 15% of the gain. Similar to STCG for equity delivery-based trades. Any gain in investment in equity-oriented mutual funds held for lesser than 1 year is considered as STCG and taxed at 15% of the gain. Denote a fund is considered equity-based if 65% of the funds are invested in domestic companies. for non-equity-oriented debt MF. As per your individual tax slab. Union Budget 2014 brought in a major change to non-equity mutual funds. You have to now stay invested for 3 years for the investment to be considered as long-term capital gain. All gains made on investments in such funds held for less than 3 years are now considered as STCG. STCG in this case has to be added to your other business income and tax paid according to your income tax slab. For example, if you are earning around 800,000 rupees per year in your normal business salary and you had STCG of 100,000 rupees per from debt funds, you will fall in the 20% slab as your total income is 9 rupees. So effectively in this example you will pay 20% of STCG as taxes. 4.5 days of holding. For an investor, the taxation difference between LTCG and STCG is quite huge. If you sold stocks 360 days from when you had bought, you would have to pay 15% of all gains as taxes on STCG. The same stock if held for 5 days more, 1 year or 365 days. The entire gain would be exempt from taxation as it would be LTCG now. It becomes imperative that you as an investor keep a tab on the number of days since you purchased your stock holdings. If you have purchased the same stock multiple times during the holding period, then the period will be determined using FIFO, first in first out method. Let me explain. Assume on the 10th of April 2014, you bought 100 shares of Reliance at 800 rupees per share. And on June 1, 2014, another 100 shares were bought at 820 rupees per share. A year later, on May 1, 2015, you sold 150 shares at 920. Following FIFO guidelines, 100 shares bought on the 10th of April 2014 and 50 shares from the 100 bought on June 1, 2014 should be considered as being sold. Hence, for shares bought on the 10th of April 2014, gains equals 120 rupees, 922 800 x 100 equals 12,000 rupees per LTCG and hence zero tax. For shares bought on June 1st, gain equals 100 rupees, 922 820 x 50 equals 5,000 rupees per STCG and hence 15% tax. Small little sales pitch here, slightly smiling face if you are trading at zero at the holdings page in our back office assistant Q will keep a tab for you on number of days since your holdings were purchased, and even a breakdown if bought in multiple trades. Here is a snapshot of the same. The highlights shows day counter, a green arrow signifying holdings more than 365 days. Selling, which won't detract any taxes if you have bought the same holdings in multiple trades. The split up showing the same. Besides 0 to Q. Equity tax P&L is probably the only report offered by an Indian brokerage which gives you a complete breakdown of speculative income, STCG and LTCG. 4.6 Quick note on STT, advance tax, and more. STT, Securities Transaction Tax, is a tax payable to the Government of India on trades executed on recognized stock exchanges. The tax is not applicable on off-market transactions, which is when shares are transferred from one demat to another through delivery instruction slips instead of routing the trades via exchange. But off-market transactions attracts higher capital gains tax as explained previously. Current rate of STT for equity delivery-based trades is 0.1% of the trade value. When calculating taxes on capital gains, STT can't be added to the cost of acquisition or sale of shares, stocks, equity. Whereas brokerage and all other charges, which includes exchange charges, SEBI charges, stamp duty, service tax that you pay when buying, selling shares on the exchange can be added to the cost of share, hence indirectly taking benefit of these expenses that you incur. Advance tax when you have realized capital gains, STCG. Every taxpayer with business income or with realized profit booked short-term capital gains is required to pay advance tax on the 15th of September, the 15th of December, and the 15th of March. Advance tax is paid keeping in mind an approximate income and taxes that you would have to pay on your business and capital gain income by the end of the year. You as an individual are required to pay 30% of the expected annual tax that you are likely to pay for that financial year by the 15th of September, 60% by the 15th of December, and 100% by the 15th of March. Not paying would entail a penalty of annualized interest of around 12% for the period by which it was delayed. When you are investing in the stock markets, it is very tough to extrapolate the capital gain (STCG) or profit that will be earned by selling shares for an entire year just based on STCG earned for a small period of time. So if you have sold shares and are sitting on profits (STCG), it is best to pay advance tax only on that profit which is booked until now. Even if you eventually end up making a profit for the entire year which is lesser than for what you had paid advance tax, you can claim for a tax refund. Tax refunds are processed in QuickTime by the IT department now. You can make your advance tax payments online by clicking on Challan No ITNS 280 on https://incometaxindefiling.gov.in/ which ITR form to use. You can declare capital gains either on ITR2 or ITR4. ITR4. When you have business income and capital gains. ITR2. When you have salary and capital gains or just capital gains. 4.7 Short and long-term capital losses. We pay 15% tax on short-term capital gains and 0% on long-term capital gains. What if these were not gains but net losses for the year? Short-term capital losses, if filed within time, can be carried forward for 8 consecutive years and set off against any gains made in those years. For example, if the net short-term capital loss for this year is 100,000 rupees per, this can be carried forward to next year. And if net short-term capital gain next year is say 50,000 rupees per, then 15% of this gain need not be paid as taxes because this gain can be set off against the loss which was carried forward. We will still be left with ours 50,000 rupees, 100,000 rupees, 50,000 rupees loss which be carried forward for another 7 years. Long-term capital losses can't be used to set off against long-term gains as in the first place. Long-term capital gains is exempt from any tax. So long-term capital loss is a dead loss and can't be set off or carried forward. Key takeaways. LTCG. Equity. 0%. Equity MF. 0%. Debt MF. 20% after indexation benefit. STCG. Equity. 15%. Equity MF. 15%. Debt MF. As per individual tax slab. You can use cost inflation index to determine and get the benefit from the indexed purchase value. Index purchase price equals indexed purchase value equals purchase value asterisk CII for year of sale, CII for year of purchase. If you have bought and sold the same shares multiple times, then use FIFO methodology to calculate holding period and capital gains. STT is payable to the GOVT and cannot be claimed as expense when investing. Interesting reads. Livement. If you pay STT, STCG is 15% otherwise as per tax slab. Income Tax India website, Cost Inflation Index Utility. Taxation of income and capital gains for mutual funds. HDFC Debt Mutual Fund Scenario Post Finance Bill Number 2. 2014. Disclaimer: do consult a chartered accountant (CA) before filing your returns. The content above is in the context of taxation for retail individual investors, traders only. Open a ZERODHA account. Chapter 5. Taxation for traders. 5.1 Quick recap. Reiterating from the previous chapter. You can classify yourself as an investor if you hold equity investments for more than 1 year and show income as long-term capital gain (LTCG). You can also consider yourself an investor and gains as short-term capital gains (STCG) if your holding period is more than 1 day and less than 1 year. We also discussed on how it is best to show your capital gains as a business income if frequency of trades is higher or if trading is your primary source of income. In this chapter we will discuss on all aspects of taxation when trading is declared as a business income, which can be categorized either as speculative business income. Income from intraday equity trading is considered as speculative. It is considered as speculative as you would be trading without the intention of taking delivery of the contract. Non-speculative business income, income from trading F&O, both intraday and overnight, on all the exchanges is considered as non-speculative business income as it has been specifically defined this way. F&O is also considered as non-speculative as these instruments are used for hedging and also for giving delivery of underlying contract. Even though currently almost all equity, currency, and commodity contracts in India are cash settled, but by definition they give rise to taking delivery, there are a few commodity future contracts like gold and almost all agri-commodity contracts with delivery option to it. Income from shorter-term equity delivery-based trades held for between 1 day to 1 year are also best to be considered as non-speculative business income if frequency of such trades executed by you is high, or if trading in the markets is your main source of income. 5.2 Taxation of trading, business income. Unlike capital gains, there is no fixed taxation rate when you have a business income. Speculative and non-speculative business income has to be added to all your other income, salary, other business income, bank interest, rental income, and others, and taxes paid according to the tax slab you fall in. You can refer to Chapter 1 for tax slabs as applicable for FY 2015-16. Let me explain this with an example. My salary, 1 million rupees per. Short-term capital gains from deliver-based equity, 100,000 rupees per. Profits from F&O trading, 100,000 rupees per. Intraday equity trading, 100,000 rupees per. Gives these incomes for the year. What is my tax liability? In order to find out my tax liability, I'd need to calculate my total income by summing up salary and all business income, speculative and non-speculative. The reason capital gains is not added is because capital gains have fixed taxation rates unlike salary or business income. Total income, salary plus business equals 1 million rupees, salary income plus 100,000 rupees, profits from F&O trading plus 100,000 rupees, intraday equity trading equals 12 million rupees per. I now have to pay tax on 12 million rupees per based on the tax slab. 0 250,000 rupees. 0% nil. 250,000 500,000 rupees. 10% 25,000 rupees per. 500,000 1 million rupees. 20% 100,000 rupees per. 1 million 200,000. 30% 60,000 rupees per. Hence total tax. 25,000 plus 100,000 rupees plus 60,000 rupees equals 185,000 rupees per. Now, I'd also have an additional income of 100,000 rupees per classified under short-term capital gains from deliver-based equity. The tax rate on this is flat 15%. STCG. 100,000 rupees per. So at 15%, tax liability is 15,000 rupees per. Total tax equals 185,000 rupees plus 15,000 rupees equals 200,000 rupees per. I hope this example gives you a basic orientation of how to treat your income and evaluate your tax liability. We will now proceed to find a list of important factors that have to be kept in mind when declaring trading as a business income for taxation. 5.3 Carry forward business loss. If you file your income tax returns on time, July 31st for non-audit case, extended to August 31st. This year, 2015. And September 30th for audit case, you can carry forward any business loss that is incurred. Speculative losses can be carried forward for 4 years and can be set off only against any speculative gains you make in that period. Non-speculative losses can be set off against any other business income except salary income the same year. So they can be set off against bank interest income, rental income, capital gains, but only in the same year. You carry forward non-speculative losses to the next 8 years. However, do remember carried forward non-speculative losses can be set off only against any non-speculative gains made in that period. For example, consider this: my hotel business income is 1,500,000 rupees per. My interest income for the year is 200,000 rupees per. And I make a non-speculative loss of 700,000 rupees. In such case, my tax liability for the year would be: my gain is 1,500,000 rupees per from business and 200,000 rupees per from interest. So total of 1,700,000 rupees per. I have a non-speculative business loss of 700,000 rupees per, which I can use to offset my business gains, and therefore lower my tax liability. Hence, tax liability equals 1,700,000 rupees. 700,000 equals 1 million rupees per. So I pay tax on 1 million rupees per as per the tax slab I belong to, which would be 250,000 rupees. 0% nil. 250,000 500,000 rupees. 10% 25,000 rupees per. 500,000 1 million rupees. 20% 100,000 rupees per. Hence, 125,000 rupees per goes out as tax. 5.4 Offsetting speculative and non-speculative business income. Speculative intraday equity loss can't be offset with non-speculative F&O gains, but speculative gains can be offset with non-speculative losses. If you incur speculative intraday equity loss of 100,000 rupees per for a year, and non-speculative profit of 100,000 rupees per, then you cannot net off each other and say zero profits. You would still have to pay taxes on 100,000 rupees per from non-speculative profit, and carry forward the speculative loss. For example, consider this: income from salary equals 500,000 rupees per. Non-speculative profit equals 100,000 rupees per. Speculative loss equals 100,000 rupees per. I calculate my tax liability as total income equals income from salary plus gains from non-speculative business income equals 500,000 rupees plus 100,000 rupees equals 600,000 rupees per. I'm required to pay the tax on 600,000 rupees as per the slab rates. 250,000 rupees. 0% nil. 250,000 500,000 rupees. 10% 25,000 rupees per. 500,000 600,000 rupees. 20% 20,000 rupees per. Hence total tax equals 25,000 rupees plus 20,000 rupees equals 45,000 rupees per. I can carry forward speculative loss of 100,000 rupees per, which I can set off against any future, up to 4 years, speculative gains. Also, to reiterate, speculative business losses can be set off only against other speculative gains either the same year or when carried forward. Speculative losses can't be set off against other business gains. But if I had speculative gain of 100,000 rupees per and non-speculative loss of 100,000 rupees per, they can offset each other. And hence tax in the above example would be only on the salary of 500,000 rupees per. 5.5 What is tax loss harvesting? Towards the end of a financial year you might have realized profits and unrealized losses. If you let it be, you will end up paying taxes on realized profits and carrying forward your unrealized losses to next year. This would mean a higher tax outgo immediately, and hence any interest that you could have earned on that capital which goes away as taxes. You can very easily postpone this tax outgo by booking the unrealized loss and immediately getting back on the same trade. By booking the loss, the tax liability for the financial year would reduce. We at Zerodha are the only brokerage in India presently giving out a tax loss harvesting report, which will spot all opportunities for you to harvest losses. Click here to learn more. 5.6 BTST ATST Is it speculative, non-speculative, or STCG? BTST, buy today sell tomorrow, or ATST, acquire today sell tomorrow, is quite popular among equity traders. It is called BTST when you buy today and sell tomorrow without taking delivery of the stock. Since you are not taking delivery, should it be considered as speculative similar to intraday equity trading? There are both schools of thought. One which considers it to be speculative because no delivery was taken. However, I come from the second school, which is to consider it as non-speculative. STCG as the exchange itself charges the security transaction tax, STT, for BTST trades similar to regular delivery-based trades. A factor to consider is if such BTST trades are done just a few times in the year, show it as STCG. But if done frequently, it is best to show it as speculative business income. 5.7 Advance tax, business income. Paying advance tax is important when you have a business income. Like we discussed in the previous chapter, advance tax has to be paid every year, 30% by the 15th of September, 60% by the 15th of December, and 100% by the 15th of March. I guess the question that will arise is percent of what? The percent of the annual tax that you are likely to pay. Yes. When you have a business income, you have to pay most of your taxes before the year ends on March 31st. The issue with trading as a business is that you might have a great year until September, but you can't extrapolate this to say that you will continue to earn at the same rate until the end of the financial year. It could be more or less. But everything said and done, you are required to pay that advance tax. Otherwise, the penalty is 12% annualized for the time period it was not paid for. The best way to pay advance tax is by paying tax for that particular time period. So September 15th, pay for what was earned until then, and by March 15th, close to the year end, you can make all balance payments as you would have a fair idea on how you will close the year. You can claim a tax refund if you end up paying more advance tax than what was required to pay for the financial year. Tax refunds are processed in QuickTime by IT department. You can make your advance tax payments online by clicking on Challan No ITNS 280 on https://incometaxindefiling.gov.in/. Also, here is an interesting link that helps you calculate your advance tax. http://www.incometaxindia.gov.in/pages/tools/advanced-tax-calculator.aspx. You can also check this link to see how exactly interest or penalty is calculated for non-payment of advance tax. 5.8 Balance sheet and P&L statements. When you have trading as a business income, you are required to, like any other business, create a balance sheet and P&L or income statement for the financial year. Both these financial statements might need an audit based on your turnover and profitability. We will discuss more on this in the next chapter. 5.9 Turnover and Tax Audit. When is audit required? An audit is required if you have a business income and if your business turnover is more than 2 rupees crores, was 1 crore rupees until FY 16/17 for the given financial year. Audit is also required as per Section 44AD in cases where turnover is less than 2 crore rupees but profits are lesser than 8% of the turnover and total income is above minimum exemption limit. We will discuss this in detail in the next chapter. However, let us understand what audit really means. The dictionary meaning of the term audit is check, review, inspection, etc. There are various types of audits prescribed under different laws, like company law requires a company audit, cost accounting law requires a cost audit, etc. Likewise, the income tax law requires the taxpayer to get the audit of the accounts of his business profession from the viewpoint of income tax law if he meets the above-mentioned turnover criteria. Check this link for FAQs on tax audit on the income tax website for more. Audit can also be defined as having an accountant verify if you have filed everything right. In this case, it is getting an accountant check if you have created a correct balance sheet and P&L statement for the year. Ideally, this audit should be done by the IT department itself. But considering the number of balance sheets out there, it is surely impossible for IT department to audit each one of them. Hence, we need a chartered accountant, CA, who is a qualified professional and authorized by income tax department to perform audits on balance sheet and P&L statements. You, the taxpayer, can use any CA of your choice. What role should a CA play? Ideally, a CA is required to only audit and sign on the balance sheets and P&L statements. But a CA also typically ends up creating your balance sheets and P&L statements and will audit them. only if required. We will in the next chapter briefly explain how a CA typically creates these two statements. The importance of the audit process by a CA cannot be understated. Apart from all the reporting requirements, an audit also helps traders, investors know their financial health. Ensure it faithfully reflects the income and claims for deduction are correctly made. It also helps lenders evaluate credibility and act as a check for any fraudulent practices. Which ITR form to use? ITR 4. We will discuss more on this in the last chapter. I have come across incidents where people have declared both speculative and non-speculative as capital gains to avoid having to declare business income and not having to use ITR 4. Taking a shortcut like this could mean a lot of trouble if called for an IT scrutiny. Business expenses when trading. Advantage of showing trading as a business is that you can show all expenses incurred as a cost, which can then be used to reduce your tax outgo. And if a net loss for the year after all these costs, it can be carried forward as explained above. Following are some of the expenses that can be shown as a cost when trading. All charges when trading, STT, brokerage, exchange charges, and all other taxes. I hope you remember that STT can't be shown as a cost when declaring income as capital gains, but it can be in case of business income. Internet phone bills if used for trading, portion proportionate to your usage on the bill. Depreciation of computer, other electronics used for trading. Rental income if the place used for trading. If a room used portion of your rent. Salary paid to anyone helping you trade. Advisory fees. Cost of books, newspapers, subscriptions and more. Key takeaways from this chapter. Speculative business income if trading intraday equity. Non-speculative if trading F&O or short-term equity delivery actively. Speculative losses can't be set off against non-speculative gains. Advance tax has to be paid when trading as a business, 30% by September 15th, 60% by December 15th and 100% by March 15th. Can claim all expenses if income from trading shown as a business income. Disclaimer: do consult a chartered accountant, CA, before filing your returns. The content above is in the context of taxation for retail individual investors, traders only. 490 responses to Taxation for Traders. ARSHDEEP. July 1st, 2015 at 5. Open a ZERODHA account. Chapter 6. Turnover, Balance Sheet, and P&L. 6.1 Turnover and Tax Audit. In the previous chapter, we discussed briefly on tax audit and when it is required if you are declaring trading as a business income. To determine if an audit is required or not, we need to first determine the turnover of your trading business. Reiterating, the requirement of calculating turnover arises only when treating trading P&L as a business income. An audit is not required if you only have capital gains income irrespective of the turnover. Turnover is only to determine if a tax audit is required or not. Your tax liability does not get affected by your turnover. An audit is required if 1 crore rupees mark turnover for the year crosses the 1 crore rupees mark. Section 44 AD, if the turnover is less than 2 crore rupees. And if profit less than 8% of turnover and total income exceeds basic exemption limit, an audit is not required if turnover is less than 2 crore rupees but your total income is within the taxable limit of 2 rupees and 50 paise LKS. This limit was extended from 1 crore rupees to 2 crore rupees from FY 16/17. I am sure the first thing that came to your mind after reading turnover is contract turnover, i.e., Nifty is at 8,000. You buy 100 Nifty. Buy side value equals 8,000 * 100 equals 800,000 rupees per. Nifty goes to 8,100. You square off the 100 Nifty. Sell side value equals 8,100 * 100 equals Rs 810,000. Turnover equals buy side value plus sell side value equals 800,000 plus 810,000 equals 1,610,000. But it is not the contract turnover the IT department is interested in. They are interested in your business turnover. Read below on how business turnover can be calculated. The method of calculating turnover is a debatable issue, and what makes it a gray area is that there is no guideline as such from the IT department. One article of great help, though, is the guidance note on tax audit under Section 44AB by ICAI, Institute of Chartered Accountants of India, the governing body for CAs. The article on page 23. Section 5.12 of this guidance note has a guideline on how turnover can be calculated. It says, delivery-based transactions. For all delivery-based transactions, where you buy stocks and hold it more than 1 day and sell them, total value of the sales is to be considered as turnover. So if you bought 100 Reliance shares at 800 rupees and sold them at 820 rupees, the selling value of 82,000 rupees, 820 by 100, can be considered as turnover. But remember that the above calculation of turnover for delivery trades is only applicable if you are declaring equity delivery-based trades also as a business income. If you are declaring them as capital gains or investments, there is no need to calculate turnover on such transactions. Also, there is no need of an audit if you have only capital gains irrespective of turnover or profitability. Speculative transactions, intraday equity trading. For all speculative transactions, aggregate or absolute sum of both positive and negative differences from trades is to be considered as a turnover. So if you buy 100 share of Reliance at 800 in the morning and sell at 820 by afternoon, you make a profit or positive difference of 2,000 rupees. This 2,000 rupees can be considered as turnover for this trade. Non-speculative transactions, futures and options. For all non-speculative transactions, the article says that turnover to be determined as follows. The total of favorable and unfavorable differences shall be taken as turnover. Premium received on sale of options is also to be included in turnover, in respect of any reverse trades entered. The difference thereon should also form part of the turnover. So if you buy 25 units or one lot of Nifty futures at 8,000 and sell at 7,900, 2,500 rupees, 25 by 100, the negative difference or loss on the trade is turnover. In options, if you buy 100 or 4 lots of Nifty 8,200 calls at 20 rupees and sell at 30 rupees, firstly, the favorable difference or profit of 1,000 rupees, 10 by 100, is the turnover. But premium received on sale also has to be considered turnover, which is Rs 30 by 100 equals 3,000 rupees. So total turnover on this option trade equals 1,000 plus 3,000 equals 4,000 rupees. The above calculations, points 1 to 3, are fairly straightforward. The next important thing to decide, though, is if you want to calculate turnover script-wise or trade-wise. Script-wise is when you calculate the turnover by collating all trades on the particular contract script for the financial year. Find average buy, sell value, and then determine the turnover using the above 3 rules with the total profit, loss or favorable, unfavorable difference on this average price. Trade-wise is when you calculate the turnover by summing up the absolute value of profit and loss of every trade done during the year, and following the above rules. Let me explain both with some examples. 100 Nifty Jan future bought at 8,000 and sold at 8,100 on 1st. Another 100 Nifty Jan future bought at 8,100 and sold at 8,050 on the 10th of January. Determine turnover using script-wise. Average Nifty Jan Foot buy. 200 Nifty buy at 8,050. Average Nifty Jan Foot sell. 200 Nifty sell at 8,075. Total profit, loss equals 200 x 25 rupees equals profit of 5,000 rupees equals turnover of Nifty Jan futures. Using trade-wise. 100 Nifty buy at 8,000. Sell at 8,100. Profit equals 10,000 rupees. 100 Nifty buy at 8,100. Sell at 8,050. Loss equals 5,000 rupees. Turnover of Nifty Jan futures equals 10,000 rupees plus 5,000 rupees. Absolute sum of the loss equals 15,000 rupees. 100 Nifty December 8,000 puts bought at 100 and sold at 50 on December 3rd. Another 100 Nifty December 8,000 puts bought at 50 and sold at 30. Determine turnover. Using scriptwise. Average of Nifty December 8,000 puts buy. 200 puts at 75. Average of Nifty December 8,000 puts sell. 200 puts at 40. Total profit loss equals 200 x 35 rupees equals loss of 7,000 rupees. Total selling value of options equals 200 x 40 rupees equals 8,000 rupees. Total turnover for December 8,000 puts equals 7,000 rupees plus 8,000 rupees equals 15,000 rupees. Using TradeWise. Trade 1. 100 Nifty deck puts bought at 100 and sold at 50. Loss equals 5,000 rupees. Selling value of options equals 100 x 50 rupees equals 5,000 rupees. Turnover equals 10,000 rupees. Trade 2. 100 Nifty deck puts bought at 50 and sold at 30. Loss equals 2,000 rupees. Selling value of options equals 100 x 30 rupees equals 3,000 rupees. Turnover equals 5,000 rupees. Total turnover equals turnover of trade 1 plus trade 2 equals 15,000 rupees. Which of the methods scriptwise or TradeWise should I follow? Calculating turnover TradeWise is the most compliant way of determining turnover. The tricky bit calculating TradeWise turnover though is that no broker, other than us at Zerodha, currently offers TradeWise turnover report. All brokers provide a P&L with an average buy-sell price, which can be used to calculate scriptwise turnover. If you are not trading at Zerodha and are looking at calculating turnover TradeWise, you will have to download all trades done during the year on an Excel sheet and calculate turnover manually. Here is the scriptwise and TradeWise turnover reports on Zerodha's reporting tool. Once you determine the turnover, you will know if you need an audit or not. That is if a visit to a CA and have him verify your balance sheet and P&L statements is compulsory, or not. 6.2 Section 44 AD. An audit is also required as discussed above if your profit is less than 8% of the turnover. By turnover I am referring to all business turnover, speculative, non-speculative, and any other business you have. And by profit I am referring to only your net business profits, not including salary, capital gains, and others. This means that if you are trading as a business and incur a loss, you will most likely have to get the books audited. But an important thing to remember is that if your turnover is less than 2 crore rupees, was 1 crore rupees, until FY 16/17, and if your profit is less than 8% of turnover, an audit is not required if your total tax liability for the year is 0. That means if your total income, salary plus business income plus capital gain, is less than 2 rupees and 50 paise LKS, minimum tax slab, you have no tax liability and hence audit not required. Applying Section 44 AD for trading as a business income is causing huge inconvenience for the retail trading community. Turnover in an ordinary business to turnover while trading on the markets is hugely different. Unlike an ordinary business where there is a fixed margin every time there is a transaction, in the business of trading there is no such guarantee. This section is an unnecessary burden that indirectly gets most small retail traders to have their books audited. We at Zerodha have petitioned to the government through this campaign on change.org. Make sure to support it and also get your trading friends to do the same. When you show trading as a business income, you will have to file using ITR4. Which would mean that like any other business you are required to create and maintain balance sheet, P&L statement, books of accounts, like discussed above. These will need to be audited based on your turnover, either turnover crosses the 2 crore mark or, in case the turnover is less than 2 crore and your profits is less than 8% of the total turnover. Creating balance sheet, P&L, and maintaining books of account is quite simple for individuals with just trading as a business income. It is explained below in brief. 6.3 Balance sheet, P&L, book of accounts, balance sheet. A personal balance sheet provides an overall snapshot of your wealth at a specific period in time. It is a summary of your assets, what you own, your liabilities, what you owe, and your net worth, assets minus liabilities. Creating a personal balance sheet is fairly simple. First, pull together all of these information. Your latest bank statements, loan statement, house loan statement, personal loan statements, principal balance of any outstanding loans, DMOT holding statement. Once you have all of that information available, start developing your balance sheet by listing all of your assets, financial and tangible assets, with its respective values. Typical examples of the assets could be cash in the bank, in hand, deposits with bank, all investments, mutual funds, shares, debt investment, property value, cost of purchase plus duty any paid plus interiors, etc. Automobile value, motor car plus two-wheeler, personal property value, jewelry, household items, etc. Other assets, computers, loans to friends, plot of land, etc. The sum of all of those values is the total value of your assets. Next, you can look at your liabilities, which should be everything you owe. Here are some common liability categories: remaining mortgage balance, loan statement, car loans, student loans, any other personal loans, credit card balances. The sum of all of the money you owe is your liabilities. The difference between your assets and your liabilities is your net worth. That's it. This is your balance sheet. Instead of creating one at the end of every financial year, it probably makes sense to update once every few months. Profit and loss statement. Profit and loss will summarize your revenue streams and your expenses for the financial year. To create your P&L for the given financial year, you will have to list down all revenues and expenses. Revenue: realized sale value from your stock holdings, capital gains, the income from F&O, intraday or commodity trades, speculative and non-speculative business income. Remember that you can't add your salary income if you are working elsewhere into your revenue stream on the P&L. Expenses: salaries, if you have people helping you trade. Rent, if you are using an office or any space for trading activity for which you are paying a rental. Income: brokerage charges, taxes, and all other trade-related expenses. Advisory fees, consultancy, depreciation of computer, and etc. Read the expenses section in the chapter on taxation traders. Revenue minus the expense equals profit. A balance sheet helps you understand your net worth between two dates, and the P&L will give you the reasons why your net worth went up or down in that period. Maintaining financial discipline is the key to long-term personal wealth creation. A personal balance sheet and P&L will ensure that you are constantly in touch with reality, your assets and liabilities. Book of accounts, bookkeeping. Maintaining book of accounts and bookkeeping seem like very complex tasks, and typical reactions I have seen from traders is to get scared of the word and try postponing the decision to learn more on the topic. Again, for an individual with only trading as a business income and or salary, it is super simple. You just need to maintain two books. Bank book. Take an Excel download of all your bank statements and make a note next to every entry to identify the nature of the transaction. It is also best to keep a copy of all the bills in case of expenses. Trading book. This should be automatically getting maintained for you by the broker where you trade. The broker should be able to give you a P&L statement including all expenses for the year, ledger statement, and an online repository of contract notes if required. Unlike what many people think, contract notes aren't really required unless a scrutiny by the IT department, and even then if only asked for the same. As a person who has traded with over 10 online brokers in India, the ledger and P&L statements with all expenses on it will show up any hidden charges by the broker. At Zeroda, we take great pride in the transparency we bring in as a business. Every charge other than brokerage is captured on the other credits, debits section on the tax P&L on Q. We also give you a summary with value of all your open option positions starting April 1st and closing March 31st. This is extremely useful when you are trying to tally your ledger with your P&L statement. We are almost done with the taxation module. The last chapter will have an explanation on what kind of ITR forms to use, and also an Excel download of a sample ITR4 form with all details as an easy reference. Key takeaways from this chapter. Audit of the books is required if turnover is more than 1 crore Indian rupees mark. Audit of the books is required if turnover is less than 2 crore Indian rupees but if the profits is less than 8% and total income more than basic exemption limit was 1 crore until FY 2016-17. Audit of the books is not required if turnover is less than 2 crore Indian rupees and profits higher than 8% of the turnover was 1 crore until FY 2016-17. Turnover does not take into consideration the regular contract turnover. Turnover refers to the business turnover. Business turnover for trading as a business can be calculated script-wise or trade-wise. Trade-wise turnover is the most compliant way of declaring turnover. If you are declaring trading as a business, then one needs to use the ITR4 form to file tax returns. ITR4 requires you to have balance sheet and profit and loss statement along with books of account. Balance sheet equation states that net worth equals assets, liabilities. P&L statement details the revenues and expenses. If trading as a business, maintaining 2 books of account becomes mandatory, bank book and trade book. It is advisable to maintain and update balance sheet, P&L, and books of account once in every quarter. Disclaimer: do consult a chartered accountant (CA) before filing your returns. The content above is in the context of taxation for retail individual investors, traders only. 455 responses to turnover, balance sheet, and P&L. HARSHENDRA Singh. July 1st, 2015 at 6:48 p.m. After open a ZERODHA account. Chapter 7. ITR Forms, the finale. 7.1 Income Tax Return, ITR, Forms. The last step of taxation is filing your income tax returns, ITR. And this can be done using ITR forms. Find below brief explanation on everything important on ITR that you need to know as an investor, trader. I have noticed from my interactions with many that they are confused between the two actions, i.e., paying income tax and filing income tax. Many are of the opinion that if they pay income tax, the act of filing income tax is not really necessary. This is not true. Let me explain why. Paying income tax: if you are employed and draw a salary, you very clearly know that your employer, on your behalf, deducts tax based on your tax slab and pays the income tax on your behalf. This is usually called tax deducted at source, TDS. Now what if you have an income sources besides your salary? For example, for the given year, assume besides drawing a salary, you also made a profit by actively trading, delivery-based equity trading. As we now know, this activity falls under non-speculative business income. Since the employer is not privy to this activity, it becomes your responsibility to declare this source of income to the income tax department and paying the appropriate amount as tax. Filing income tax returns. Filing income tax returns is a mandatory way of communicating to the IT department all the sources of income you have, including your salary. An income tax return form, ITR, form is simply a form that you need to fill up declaring your sources of income. There are different ITR forms for different sources of income. You may wonder why I should file my returns when I don't have any other source of income besides salary. Well, in such a case, by virtue of filing your income tax returns via appropriate ITR form, you are officially communicating to the income tax department that you do not have any other source of income. So in essence, the act of filing your returns is your official communication to IT department about all the source of income that you have along with the tax you have paid against that income. You do this via the prescribed ITR forms. More formally, an ITR is a prescribed form through which the particulars of income earned by a person in a financial year and taxes paid on such income are communicated to the income tax department. There are different types of ITR forms. One needs to select the appropriate ITR form based on the different sources of income. These forms can be downloaded from here: https://incometaxindefiling.gov.in/. 7.2 ITR Forms and its uses. In the context of this module, which is focused towards individuals having investments as capital gains or trading as a business income, the important ITR forms to know about are: ITR 1 when you have only salary, interest income, or rental income from only one house property. You can use ITR 1 forms to file your income tax returns. This is the most common type. But if you have capital gains or trading as a business income, you can't use this ITR form. ITR 2 when you have salary, interest income, income from house property or income from capital gains. You can use ITR 2. So if you are an individual who only invests in the market, remember investor, hence capital gains, you need to use ITR 2. ITR 4 when you have salary, interest income, income from house property, income from capital gains, and income from business, profession. You can use ITR 4. So if you are an individual who is declaring trading as a business income, you have to use ITR 4. If you are an investor and trader, you can show trading under business income and investments as capital gains on the same ITR 4 form. ITR 4S STCG. This is similar to ITR 4 but with presumptive scheme if Section 44AD and 44AE used for computation of business income. ITR 4S can't be used to declare any capital gains of if losses has to be carried forward, so you can use ITR 4S only if you have business income, speculative plus non-speculative. But it is best avoided if by use of this form you are reducing your tax liability. 7.3 Exploring ITR 4S. The advantage of ITR 4S is that it can be used by taxpayers who do not maintain regular book of accounts or want it to be audited. Refer Chapter 2, provided your turnover is lesser than 2 rupees crores for the year. You can get away without maintaining books or getting audited if you firstly calculate turnover based on Section 44AD, check the previous chapter, and then declare 8% of this turnover as your presumptive income. You have to then pay taxes adding this 8% of the turnover to your other income and pay taxes per the slabs. So if you are a trader with turnover less than 2 crore rupees for the year, was 1 crore rupees until FY 15/16, and profit less than 8% of the turnover with only business income, not possible if you have capital gains. You can declare presumptive income of 8% of the turnover and get away from the need to get your books audited. There is no need to pay advance taxes if you are using ITR 4S. But you are not allowed to deduct any business expenses against your income. For example, assume my salary was 500,000 rupees per for the last FY, and I had incurred F&O loss of 25,000 rupees per on a turnover of 400,000 rupees per. Since my profit is less than 8%, 25,400 thousandths of my turnover, I will need to use ITR 4, maintain books, and have them audited. Instead of this, I could use ITR 4S and declare 8% of 400,000 rupees per business turnover, or 32,000 rupees per as my presumptive trading business income even though I have incurred a loss. My total income for the year is 500,000 rupees, salary, plus our 32,000 business income equals 532,000 rupees per. Therefore my tax liability would be as follows. Up to 250,000 rupees no tax. Between 250,000 rupees to 500,000 rupees 10% 25,000 rupees per. Between 500,000 rupees to 532,000 rupees 20% 6,400 rupees. Total tax equals 25,000 rupees plus 6,400 rupees equals 31,400 rupees per. Here, by virtue of declaring a presumptive business income of 32,000 rupees per, I'm paying additional tax of 6,400 rupees per. This works out to be a cheaper alternative than getting an audit done, for which the CA fees could have been 15,000 rupees per and above. So using ITR 4S would make sense only if your turnover is low. Hence declaring 8% of turnover as income would work out cheaper than paying an audit fees to the CA. 7.4 Quick fact and notes. How to file the return of income electronically. Income Tax Department has established an independent portal for e-filing of return of income. You can log on to www.incometaxindefiling.gov.in for e-filing the return of income. Check this very nice video on e-filing put by the IT department. Is it necessary to attach documents along with return of income? ITR return forms are attachment-less forms. Hence, along with the ITR form, whether filed manually or filed electronically, you are not required to attach any document like proof of investment, TDS certificates, etc., unless if you fall under the audit case. However, these documents should be retained by you and should be produced before the tax authorities when demanded in situations like assessment, inquiry, scrutiny, etc. But in audit cases, soft copy of balance sheets, P&L, and any notes along with the audit report needs to be attached. What is the difference between e-payment and e-filing? E-payment is the process of electronic payment of tax, i.e., by net banking or SBI's debit credit card. E-filing is the process of electronically furnishing, filing, of return of income, using the e-payment and e-filing facility. Payment of tax and furnishing of return is quick, easy, and hassle-free. Is it necessary to file return of income when I do not have any positive income? If you have sustained a loss in the financial year, which you propose to carry forward to the subsequent year for adjustment against subsequent years' positive income, you must make a claim of loss by filing your return before the due date. What are the due dates for filing returns of income loss? If no audit, July 31st. If audit, September 30th. What is to be mentioned as nature of business on ITR 4? Nature of business can be mentioned as Trading Others Code 0204. If I fail to furnish my return within the due date, will I be fined or penalized? Yes. If you have not furnished the return within the due date, you will have to pay interest on tax due. If the return is not filed up to the end of the assessment year, in addition to interest, a penalty of Rs. 5,000 shall be levied under Section 271F. How to show profit and loss on balance sheet. You can show all positive turnover as gross receipts and negative turnover as gross sales. Can return be filed after the due date? Yes, you can. Return filed after the prescribed due date is called as a belated return. If one could not file the return of income on or before the prescribed due date, then he can file a belated return. A belated return can be filed within a period of 1 year from the end of the assessment year or before completion of the assessment, whichever is earlier. A belated return attracts interest and penalty as discussed in previous FAQ. For example, in case of income earned during FY 2013-14, the belated return can be filed up to the 31st of March, 2016. However, if return is filed after the 31st of March, 2016, penalty under Section 271F can be levied. If I have committed any mistake in my original return, am I permitted to file a revised return to correct the mistake? Yes. Provided the original return has been filed before the due date and the IT department has not completed the assessment, it is expected that the mistake in the original return is of a genuine and bona fide nature and not rectification of any deliberate mistake. However, a belated return, being a return filed after the due date, cannot be revised. Return can be revised within a period of 1 year from the end of the relevant assessment year or before completion of the assessment, whichever is earlier. Example, in case of income earned during FY 2013-14, the due date of filing the return of income considering no audit is the 31st of July, 2014. If the return of income is filed on or before the 31st of July, 2014, then the return can be revised up to the 31st of March, 2016, assuming assessment is not completed by that date. However, if return is filed after the 31st of July, 2014, then it will be a belated return and a belated return cannot be revised. ITR forms are typically Microsoft Excel sheets where you can fill all the relevant details, and the calculations happen automatically. Find attached an ITR4 form with all types of income, salary, capital gains, trading as a business, and rental income. This should act as an easy reference if you are trying to fill this on your own. This is the ITR4 form from I-14/15, FY13/14. Sample ITR4 form 2014-15. Sample ITR4 form 2015-16. Sample computation. Key takeaways from this chapter. The act of paying your taxes is called tax payment, which can be done via e-payment. The act of communicating different sources of income and tax paid against that is called income tax return filing. Filing income tax returns is mandatory, even though you have paid taxes. An ITR form should be used to file taxes. Use different ITRs for different sources of income. ITR4S for presumptive business income. Use this to lower your cash outflow paying taxes versus audit fees. Phew. That brings us to the end of the taxation module. Keeping it simple is most challenging, especially a topic like this where almost every other word is a jargon. Hopefully I have done a decent job with it. And this module acts as your ready reckoner for everything on taxation when trading and investing. Financial discipline is the key to long-term wealth creation, and it starts with compliant filing of your income tax returns. It is best not to avoid or postpone, especially with advancement of technology and reach of our income tax department. Do help spread the word. Happy trading. Nitin Kamath. Zeroda. Special thanks to Tax IQ for providing valuable inputs throughout this module. Disclaimer: do consult a chartered accountant (CA) before filing your returns. The content above is in the context of taxation for retail individual investors, traders only.